Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Managing Investment Risk, Strategies to Protect and Grow Your Portfolio. Asset Allocation, structuring your portfolio to lower risk. Asset allocation is about dividing your investments across different asset classes, such as stocks, bonds, real estate, and cash. Why? Each asset class behaves differently under various market conditions. By spreading your money among them, you reduce the chances of a single downturn wiping out your portfolio. For example, when stocks experience a bear market, bonds, especially government bonds, often perform relatively well. Similarly, real estate or commodities like gold can provide stability during periods of inflation. A well-balanced portfolio ensures that if one category falters, others can help cushion the fall. The balance of your portfolio should align with your risk tolerance and time horizon. For younger investors with decades to invest, a heavier weighting toward stocks might make sense, as they offer higher growth potential with time to recover from dips. Conversely, someone approaching retirement may prioritize bonds and cash equivalents for stability. Think of asset allocation as the foundation of your portfolio. It sets the stage for everything else you do as an investor. Dollar cost averaging, mitigating market timing risk. When markets are volatile, the temptation to time the market can be strong, but it's notoriously difficult. Dollar cost averaging, DCA, is a simple strategy that helps you avoid the risks of trying to predict short-term market movements. With DCA, you invest a fixed amount of money on a regular schedule, regardless of market conditions. Here's how it works. Say you decide to invest $500 every month in a mutual fund. When the market is down, your $500 buys more shares because prices are lower. When prices rise, the same $500 buys fewer shares. Over time, this averages out the cost of your investments, reducing the impact of market highs and lows. This strategy is particularly useful for long-term investors who regularly contribute to retirement accounts or other savings plans. It removes the emotion from investing, keeping you consistent even during uncertain times. DCA won't guarantee profits, but it's a powerful tool to smooth out the bumps and take advantage of market dips when they come. Hedging against risk, exploring protective tools. Hedging is like buying insurance for your portfolio. You use financial instruments, such as options, futures, or other derivatives, to protect against potential losses. While these tools are often seen as complex or reserved for advanced investors, they can play a valuable role in risk management when used thoughtfully. Options. Buying put options, for instance, gives you the right to sell an asset at a predetermined price. If the asset's value falls below that price, the option limits your losses. Futures. Futures contracts allow you to lock in prices for assets, which is particularly useful for managing risk related to commodities or currency fluctuations. Inverse ETFs. These funds are designed to rise in value when the market falls, offering a way to offset a downturn. While hedging can help manage risk, it's not without its own costs. Derivatives can be expensive or complicated, and they require careful monitoring. If you're new to these tools, it's a good idea to consult a financial advisor or start small to understand how they work in practice. Rebalancing your portfolio, maintaining your risk levels. Rebalancing is the process of periodically adjusting your portfolio to ensure it stays aligned with your desired risk level. Over time, market changes can shift your asset allocation. Some investments may grow faster than others, and your portfolio may become unbalanced. For example, imagine your target allocation is 60% stocks and 40% bonds. If stocks perform well and grow to represent 70% of your portfolio, you're now exposed to more risk than you originally intended. Rebalancing involves selling some of your stock holdings and reallocating that money to bonds to restore your original mix. You can set a schedule to rebalance, such as annually, or rebalance when specific thresholds are crossed, e.g., when an asset class deviates by 5% or more from your target. While rebalancing requires discipline, it's an effective way to lock in gains from outperforming assets and ensure your portfolio doesn't take on unintended risks. It's like tuning an instrument. Small adjustments keep things running smoothly over the long haul. Common mistakes in investment risk management. Managing risk in an investment portfolio is an ongoing process that requires attention, strategy, and a clear understanding of your goals. However, even the most well-intentioned investors often fall victim to common mistakes that can jeopardize their returns. Let's explore these pitfalls and how avoiding them can protect your portfolio. Overestimating risk tolerance. One of the biggest mistakes in risk management is overestimating your ability to handle losses. It's common to feel bold when markets are up, but when things take a downturn, overconfidence can quickly lead to regret. What happens when risk tolerance is misjudged? Imagine someone who claims they can handle a 30% drop in their portfolio but panics and sells everything as soon as they see a 10% decline. This emotional response locks in losses and disrupts long-term growth plans. Overconfidence often stems from misunderstanding how losses feel in real life versus on paper. To avoid this, ask yourself honest questions about how much fluctuation you can truly accept. Consider past experiences with money and losses. How did you react? Be realistic about your comfort zone. It's better to build a portfolio that aligns with your true risk tolerance than to create one you'll abandon in tough times. Neglecting diversification. Failing to diversify is like putting all your chips on one number at a roulette table. It's risky, and the odds aren't in your favor. Yet, many investors concentrate their funds in a single stock, sector, or asset class, leaving their portfolios vulnerable to significant swings. Why is this so dangerous? For instance, if most of your money is tied up in tech stocks, a downturn in that sector could have an oversized impact on your entire portfolio. You're not just betting on the success of a few companies, you're taking on extra exposure to risks specific to those businesses or industries. To ensure better protection, spread your investments across different asset classes, stocks, bonds, real estate, etc., and sectors like healthcare, energy, or consumer goods. Even within a single asset class like stocks, diversify by geography, company size, or market type. Diversification doesn't eliminate risk entirely, but it significantly reduces the impact of any single investment's failure. Reacting emotionally to market fluctuations. Emotions and investing rarely mix well. Yet, so many investors let fear or greed drive their decisions, especially during market highs and lows. When markets drop sharply, fear sets in. It's tempting to sell in an attempt to cut losses, but this often results in selling low and missing out on eventual recoveries. On the flip side, when markets are booming, greed can push investors to buy more of an overvalued asset, chasing returns that may not last. Both scenarios are recipes for trouble. Discipline is key to avoiding these traps. Create a well-thought-out investment plan that aligns with your goals and stick to it, even when your instincts are screaming to do otherwise. Having a strategy in place helps you see the big picture and avoid short-term knee-jerk reactions. Remember, making an investment decision based on emotion is like driving a car blindfolded. Chances are, it won't end well. Mistakes are part of learning, but when it comes to investment risk management, some are simply too costly to make. Identifying and addressing these common errors early can be the difference between a thriving portfolio and one that struggles to meet your goals. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.